my U.S. business was over $500 million. And then after that merger, I ran a $1.6 million U.S. business for Dental Supply Sorona.
Hello, everybody. Welcome to Commercial Real Estate Secrets. I'm your host, Austin Hare. Our guest is Michael Augins. Michael Augins is co-founder and president of Imagen Dental Partners. They're DPO that started in March of 2020, and they're one of the only DPOs that focuses on high technology practices. They've rapidly expanded into 8 states and have plans to add 6 more states in 2022. Right now, they're growing at a rate of 3 to 5 partners a month. And Michael, thanks for coming on the show.
Hey, thanks so much, Austin. Pleasure to be here.
Yeah, so our story is a little bit interesting. We've had a lot of guests on the show, but through dental and through healthcare. But you and I actually met through wakeboarding a long time ago.
Well, I mean, yeah, you were much better wakeboarder than me, but yeah, I appreciated getting to spend the day watching you because you're awesome.
Oh, thanks, man. It's one of the first times that wakeboarding and dental has really intersected in my life, and so yeah, it was how many years ago was that we were out there doing some riding?
We were out on Lake Riley, and this had to be now 15 years ago, back when I could still ride pretty well.
Yeah, crazy. Yeah, so yeah, it's cool. Obviously, both from the Charlotte area, have lived in the Charlotte area for a little bit of time, and so it's nice to have those things in common. But yeah, I want to talk about you. I want to find out more about you. Obviously, you didn't wake up president of a giant DPO or a growing DPO. I mean, there's a lot of things that happen along the way, and so I like giving encouragement to people who are trying to figure it out, trying to better their lives and improve and have self-improvement and development and better their businesses. And so, I mean, for you, what part of the country were you born in, and what was your childhood like? How did that shape you?
So we moved around quite a bit when I was a child. I was born in Syracuse, New York, but then we moved to the DC area and then out to San Diego. I finished up high school out there and then started a company my freshman year in college. Took me to Florida.
Oh, nice.
And then ultimately moved around a bit after that. But probably the most formative places were the DC area and San Diego.
How old were you when you were in those places?
So I was in the DC area from 4 to 14, and then I was in San Diego from 14 to 20.
So what were your parents like? Was there a high work ethic environment? Was there emphasis on sports or entrepreneurship? I mean, what was growing up like when you were in those areas?
So it was, for me, my parents were both fairly driven. My father started a company that was a small defense contracting company. And the reason we moved around a bit was because his initial deals were in DC, and then he got a big contract with the Navy out in San Diego, which took us out there. He was very much into education and hard work, and that's what gets you to where you want to be. My mother was originally a journalist and then became a home ec teacher. And then ultimately, when my dad sold his business, they went to Asheville, and she started up a yarn shop up in Asheville.
Wow, that's cool. So you got to see your dad build a business from the ground up?
Mm-hmm. I did. So he was working for a company and decided that, hey, I think I could build a business. Built a mid-sized firm, built it, sold it, and ultimately was able to retire at about 50.
Wow.
My dad's dad unfortunately passed away at 50, so it was always my dad's goal to not kind of, quote unquote, by his words, die at work like his father did. So, fortunately he's still with us, and that was a long, long time ago, and he would have told you he probably should have worked another 15 or 20 years, but that was his goal, and he was able to achieve it.
Wow, good for him. Yeah, it's super influential seeing somebody seeing your father, seeing people in your close proximity being able to build a business. I mean, it's a very rare thing. I tell people the best gift my dad ever gave me was just the process of how to think about life and how to learn. And so it's when I was 17, he gave me my first kind of self-development book. It was The Psychology of Winning by Dennis Wheatley. And that was the first time I'd ever been exposed to anything like that. And I was just fascinated. I just was wow, this stuff is so crazy and so good. And it was really the mindset. That was the biggest gift that my dad gave me was the mindset. And so it's cool when you see that, how different circumstances have influenced people. And it sounds like your dad was a big influence on you when you were growing up.
He definitely was. And, I wasn't as smart as you. My dad tried to get me Tony Robbins was kind of a young rising star in San Diego. My dad tried to get me involved in that when I was about 17, and I was kind of a rebellious kid and kind of pushed back against that. But probably the biggest debt. I mean, all of us owe a huge debt to our fathers. But my dad gave me $10,000 to start my first business, and kind of gave me the freedom to go out and do that, and made me write up a business plan and tell him what I was going to do with the money. And probably, I think both of us would say that was kind of a crucial moment.
Yeah.
When he kind of forced me to really structure my thoughts and put in the thinking, and then ultimately gave me the seed funding to start that business. That was pretty impactful.
That's cool. So what was the business model like? What did you guys do?
So I invented a product that let people drink faster out of the bottle.
That definitely sounds like a college age invention.
Yeah. So what we found, it was particularly popular on college campuses and down in Mexico on spring break. And so it's an interesting story. It might get a little bit
Let's hear it.
away from real estate.
Let's hear it. I love it.
So I invented this product called the Bottle Buddy. I literally started taking them down with me to Tijuana, where in San Diego, if you were underage, you'd go down,
right?
And people would buy them for me, and I could go down with a backpack full of Bottle Buddies and make $500 in a night.
Wow.
And it was a pretty good thing. But then the biggest market, of course, for that kind of thing was spring break, and so went down to spring break in Mazatlan, Mexico. And started selling Bottle Buddies, but ended up transforming the company into what became the largest event management company for spring break, and brought that to a couple destinations.
Man,
that became a more appreciable business.
Yeah, event management is no joke. I mean, they're hard. I mean, they're very profitable if you do them right, but it's like very hard to get them up and get them started. So was the loan or the grant from your dad to get started for the Bottle Buddy business, or was it for the event side of things?
Well, I started the Bottle Buddy business, and I kind of did it out of my small apartment I was making myself. And when I was going to go down to spring break, and when there was enough demand, my dad basically lent me the $10,000 to make the Bottle Buddies to go down to spring break and to really kind of scale the business. And I at the time didn't have enough saved up to get the kind of quantity produced to take advantage of the opportunity. So the loan my dad gave me was
okay. So you made a massive order, and were you making decent enough money to where you could pay all the bills? Was it like a side hustle? Did you think about dropping out of college? Was the money that good? Like, what was the opportunity like?
So I over the course of 4 years, I sold about 185,000 at $5 a piece.
Wow.
So grossed about 900,000 over 4 years. It was good enough to be a very good college living in 1990, but it wasn't like drop out of school and do this. But what I did do once I started the event management company, and really it was focused on spring break as well. I mean, to really be perfectly honest, we threw the parties that the tour operators would bundle into their packages.
Wow.
And when they brought kind of people down for a week, we had a product called the Gold Card, and we had a product called the Beach Bash, and a couple other events that people would bundle into their packages. And that became fairly profitable. I mean, we built that up into a couple $1 million business.
Wow, that's cool. And so did you keep doing that after college, or did the Bottle Buddy and this kind of end at the same time?
So I'm probably the only dental executive that was a 9-year undergrad. So what I did, and it was part of a deal that I cut with my parents, is I kept going to class one semester a year, and then I'd run my Bottle Buddy business and my spring break business. And the true story about what happened was, I was doing this, the event business was going very well, and then my girlfriend at the time and I, she was expecting, so we got married, and I needed to figure out something other than a spring break oriented.
Now that you're going to be a family man.
Yeah, now I'm going to be a family man. So it was so I was surprised by this. So here's a lesson for all your listeners: your college credits don't contribute to a degree program after 10 years.
Oh wow!
Right? They have an expiration if you're using them for a degree. And the only year that I had gone full-time to school was my freshman year. So here I am, I'm 8 years in, and if I don't graduate before 10 years, I lose my only full year, and so I fall another year behind. And so I rushed together. I talked to a bunch of college advisors, said, hey, how am I going to get my business degree and do this in time, right? Because I've got to kind of get this done because my goal was to go to business school. And I'd already been told by a number of business schools, hey, with your test scores and your background and your entrepreneurship, you just need to get your degree.
They like,
So I kind of
probably,
cobbled together a degree
they
program.
like seeing that business that you owned and operated at the time, right? I mean, that's probably a huge benefit.
Yeah, so this is 1997 when in 96 and 97 when I'm doing this, and then all the entrepreneurial people were trying to get into the .com craze, right?
Right.
Everybody was starting up a .com. It was just crazy, but the most entrepreneurial people in the world at that time weren't going to business school. So business schools wanted to find entrepreneurs, and I had I guess what you would call untraditional but impressive track record of of growing a couple of businesses, and so that was highly regarded by business schools. So another lesson is entrepreneurial people don't usually go back to business school because they start their business, and so all the top business schools in the world are looking for people that have true entrepreneurial skills.
So what was it like? I mean, going from having started your own successful company to now going back into school, I mean, did you find it? I feel like it's very polarizing. Either you're going to say, oh yeah, I loved it and I ate it up, or it was all stuff I already knew.
No, it was interesting because I learned a lot. I went to the University of Virginia's Darden School. My wife didn't want to go north of the Mason-Dixon, so the best business school in the South is at UVA, and so
That sounds like my life. Yeah, she's a Southern girl all the way.
yeah. I mean, I might have gone up to Boston, but she wasn't. She wasn't. So so we decided on Virginia, and and it was a great experience, and I learned a lot of lessons. So once you have a family, you become much more structured, right? Up until that point, I was kind of not really following a plan. I was kind of taking advantage of the opportunities that were before me and kind of, I would say, living off the hustle and the ability to pivot and the ability to see opportunity and deliver on that opportunity. When I went back to business school, I had a plan. My plan was I am going to go to business school. I am going to not be the spring break guy so that I can do anything I want. And I'm going to learn how to run a much larger business. And I'd written all that out in my admission essay, which I still keep to Darden, right? Here is my plan. And it literally said, I'm going to graduate Darden, I'm going to go to McKinsey, and I'm going to run a larger business. That was what it said. And ultimately, because of the specificity of that plan, I was able to do exactly that. So I graduated Darden, got recruited by McKinsey's Atlanta office, went down to McKinsey for a couple of years, which was another learning experience, and ultimately transitioned to dental. But back to the story and the direct answer to the question, I really loved the business school experience because while I had a lot more experience in actually running a business and in things like operations and sales, what I undervalued was things like organizational behavior, courses around financing, which I got a ton out of throughout my life, really being able to value and structure businesses. And so there was a whole skill set that I acquired during that time at
Yeah,
Darden
like the
that I
accounting
didn't have
side.
as a scrappy entrepreneur, right?
Like you're talking about on the accounting side of things, kind of, right?
Yeah, on the accounting and even more importantly, so kind of accounting is important, but you can, to be perfectly frank, you can hire people to do your accounting for you.
Okay, great.
But if you have the ability to really think through the power of leverage and the power of creating a model that lets you preserve equity in a business, but still get the financing and capital you need, those are powerful concepts in business because I think that for a lot of entrepreneurs, what happens is when you take in outside capital, you have to sell off too much of the upside. And so being able to be really kind of disciplined, smart, and creative in that aspect can pay enormous dividends down the road.
Yeah, let's talk about that real quick because even in now with DSOs and DPOs and healthcare organizations, there's always that push and pull. There's between bootstrapping, bank debt, and private equity. And so it seems like the longer you can wait before you take on private equity, the less equity that you have to give up. So, like, what were some of the lessons that you learned? Like, how would you go about balancing those things?
So I think that the basic concept that everybody should think of is, as an entrepreneurial founder, one of your goals should be to, so you, of course, you want to create the most value out of your company you can, so you need capital to be able to grow, but you also want to maintain as much of the equity as you can because you want to be able to, you're going to create, hopefully, a lot of wealth, and you want to keep as much of that as possible. And so I think that, most entrepreneurs should be scrappy and bootstrap until they get to the point where they can scale. And then private equity can be a meaningful benefit because they can help you with a number of things. They can help you with capital. They can help you if you need the help with strategic thinking, and they can help you with organizing an exit if that's your
Mhm.
goal. And so there is a powerful case for private equity, and we'll talk about it later. But with Imagen, since both my co-founder Rezwan Manji and I had experiences with private equity, our goal was to how could we scale without having to use private equity and still have that ability to scale. But that actually requires certain things that aren't going to be at the beginning of your entrepreneurial career. Like the ability to raise tens or hundreds of millions of dollars isn't easy if you're just starting out. So I think everybody's goal should be to get independent enough to grow their business with their own capital. But realistically, for most entrepreneurs, leveraging institutional capital can be of real benefit when you're trying to scale.
Yeah.
So it's different phases of business, right? When you're starting up, do it all with your own money. Get a foundation that you can scale with. The right time to think about bringing in an outside investor is when you've got a scalable plan and clear vision on how you're going to accomplish it, and you know what you're going to use that capital for.
Yeah, I like it. Yeah, because, in simple terms, when you take on institutional capital or bank debt, you're giving them a fixed interest rate. And so maybe it seems high or whatever, maybe you don't want to pay it, but what's the alternative? Is it better than giving away a piece of your company? And that means it's not a fixed interest rate, it's a growing, the cost of that money is a lot higher than the interest rate because they're getting a piece of the upside. And so yeah, it seems like if you can, a lot of people, what they do is they start with bank debt and they grow as much as they can and as fast as they can. And at some point they get to a hex where the bank's not comfortable lending the money or just they can't get the money fast enough. And then at that point it's like, okay, it's time to take on private equity. But hopefully along with that equity of your business that they're taking, they're also going to provide structure and guidance and even, people to come work with you.
Yeah, and there can be some private equity firms, each is different, but some add a lot of value to the business, no doubt. But to your initial point, right? So one of the most fundamental premises of finance is that debt is cheaper than equity because people's expected return on the risk of equity has to be higher because debt is secured by assets, equity is unsecured by its very nature. And so as you move down that continuum, right? So bank debt is the cheapest debt, then you could get mezz debt, or you could get some basically what amounts to riskier debt that comes with a higher return. And then you get into different equity types in terms of its cost to you. And that's what I was saying, like one of the biggest lessons for me out of business school was the ability to create the right, what financial people call the capital stack, right? But to use each of those different sources of capital, right? Your own equity, outside equity, bank debt, mezzanine debt, perhaps other structures to really optimize the returns for the.
Yeah, I remember when I first heard about mezzanine debt, it was 12% interest and or whatever it is. It was like, 2 or 3, 4 times higher than the bank. And well, right now. And I just remember thinking like, wow, what a ripoff. Like, why would you ever pay that much money how can you ever make money? And so now I've refined my thinking a little bit and I realize the value of it because what's the alternative? If you don't have the money yourself, then the alternative to mezzanine debt is private equity. And they might end up getting a lot more than 12%. Hopefully your business is making more than 12% return on the capital that you invest. But it does serve a good purpose in those situations.
Yeah, this might be getting too deep into finance for some,
Yeah.
but right. So all forms of capital come with an expected return, right? And so banks today are going to be between 3 and 5%. Mezz debt can be between 8 and 15%. And that's all related to the perceived riskiness of the investment. But private equity funds are seeking a 25 to 30% return on their equity. Now they have an advantage. They can usually deploy leverage more meaningfully than the underlying business can. And so they sometimes can put more debt on the business and juice that because the more debt you have on the business, the bigger your debt structure, the higher the return for the equity holders. And so private equity owners use debt to juice their returns. But the fact of the matter is they're not doing a deal that they don't think they can get at least 25 to 30% return on. And so if you need that to grow, that's great, right? But if you don't, you'd rather get that 25 to 30% return for yourself, right? Which is always the conundrum.
Yeah, exactly. So it's always a balancing act. I mean, there's no like magic bullet. There's no perfect answer. It always just depends on so many variables. But no, and I think it's helpful. I don't think it's getting too deep into the weeds. I think like at some point, everybody's, entrepreneur is going to have to at least think about these types of things. And so hopefully this sheds some clarity on that or sheds some light on that. But yeah, so you have mentioned you went to business school and then you graduated. And then what was after that for you?
All right, so I graduated from business school and I went to McKinsey & Company, and McKinsey is, I believe, still the world's preeminent strategy consulting firm. So 70% of the Fortune 500 engage McKinsey on various topics, including what I did, which was growth strategy. And so, being entrepreneurial and being strategic was a benefit. And so companies would engage McKinsey to help them think about what were their best opportunities for growth, and then how do we go and execute that. And so I joined that practice group when I joined McKinsey.
Okay, and what was your roles and responsibilities there? How long were you there for?
So I was there for 2.5 years. I mean, it was a great time to be at McKinsey, and the reason why is if you were entrepreneurial in '99, right, that was the height of the dot-com rush, right? Mm-hmm. And so the growth strategy group really needed people, and you could very quickly elevate in your career. So I got a couple battlefield promotions very quickly. So what happened at McKinsey was started out in the Atlanta office, got on a couple of growth strategy projects, weren't first in healthcare, but then I did do a pretty large healthcare project. And once you've got experience in that sector and you're in that group, they put you on other projects within that sector.
Okay.
And so I had just kind of gotten like a battlefield promotion to lead teams, and I got put on as an engagement manager, which you don't usually get to do that after a year and a half into time, right? And I went out to and took a study for the private equity group that owned Sorona Dental. So Sorona had spun out of Siemens, and the largest private equity firm in Europe at the time was a company called Premier, and they owned Sorona. And so Sorona and Premier engaged McKinsey to look at a problem they had. And the problem was that CEREC was growing rapidly in Europe, but hadn't really taken off in North America. And they didn't understand why such a great product wasn't getting the traction that it should. And they engaged McKinsey to say, hey, what is the potential and how do we exploit the potential, or capture the potential? I shouldn't say exploit, but capture the potential of the product in the North American market. And so that team was based out of Germany because that's where Sorona was located. But I got put on to run the North American piece of that study.
Okay. And then what was it? I mean, just curious, why were they having hard times growing in North America? What'd you help them?
So, I mean, we did a ton of research. I worked on this for almost a year, but the truth was the wrong people were telling the story. Like if I were really to boil down a year's worth of work into a single insight, the way that we really got CEREC going in North America was by having happy owners tell their story about why they loved CEREC. Because CEREC was the most expensive piece of technology in dentistry, still is. And it was almost $100,000 decision, and the only $100,000 decision that dentists in 2001 had ever made was whether or not to buy a house or maybe to start up their office, acquire their practice. But this was a big decision. And at the time, Patterson was selling it, but salespeople were perceived as having kind of a vested interest in selling the product. And so doctors had these perceived judgments about CEREC that were generations old, but they didn't realize what the technology could do by the time that it was 2001. But they weren't trusting, to be frank, of the sales rep to convince them of that. So the most astonishing thing that I learned in that, and it really was a powerful insight, we ran focus groups to learn about about what people liked and didn't like about CEREC. And in those focus groups, I started having passionate owners present CEREC and why they loved it so much to the groups. At the end of each of those focus groups, a couple of dentists came up and asked me, how do I buy this thing? Right? Because they were inspired by the passion of the owner that had explained the story and why they loved it so much. And so we took that, and we had seen already that some peer-to-peer selling events had worked in some other places, and I started really kind of driving research around the concept of peer-to-peer selling, right? Getting passionate users of a product to articulate why they were so passionate about it to groups of interested clinicians. And that concept is more commonplace today, but it was fairly ad hoc. And so CEREC sales went from under 100 units a year in 2001, or maybe it was just over 100, to about 1,700 units a year by 2007 on the basis of rolling out a national program for peer-to-peer selling.
So, wow, that's crazy. 170 times more sales.
Yeah, 17 times.
Or 17 times.
Yeah, 17 times more sales. Yeah, but within 4 years, which is incredible. And all we really did, there was this 10-point plan, this beautiful 100-page deck and all this stuff. But if you ask me, 20 years later, and the guy who actually ran the program, the most impactful things was we worked in collaboration with Patterson to fill rooms of interested doctors and then had doctors tell their story. And that's what.
So how do you motivate other doctors to tell their story? I mean, are you allowed to give them commissions, stuff like that?
Yeah, you can't really give them commissions, but the commonplace model in dentistry is to pay an honorarium to speak. And so doctors receive honorariums from companies to do presentations to compensate them fairly for their time in presenting it. But I would say that our doctors didn't do it for the money, and the doctors we wanted, we wouldn't have. We paid a fair rate, which was similar to what they could make doing dentistry on that day. But we didn't overpay because it wasn't pay for play. These people were actually speaking about their passion, and that's what worked, right? If you got a hired gun up there that just was trying to make money and they couldn't authentically speak to the audience, it wasn't effective. And so, I was a strategy consultant, so we measured the effectiveness of different speakers, and the ones that really you had to be articulate and charismatic. Those were factors that helped. But you really had to be passionate and tell your story. And people who would tell their story and it would resonate with the audience were the ones that were most impactful in actually driving people to purchase the product.
Cool.
So Austin, we were talking earlier about the envisioning session, and really that was incredibly insightful and became the basis for what became Imagen. So the most important exercise we did at that envisioning session is we talked to these great technology doctors and we asked them, what do you like about independent dentistry? And their answers were remarkably consistent. What they liked about independent dentistry was the ability to control the shots, particularly the ability to have what they call complete clinical autonomy, which is doing what's right for their patient in the way that they want to do it. They wanted to have skin in the game, meaning they like the upside of ownership. And they also want to be able to preserve the culture of their practice and kind of run it their way and their brand. It's kind of their child, their baby almost, and they love that about it. But there's some things also that all of these dentists told us that they don't like about independent dentistry. And what they don't like about independent dentistry is the feeling of being alone, the fact that they don't have the capital to compete for the marketing programs and to buy the same as large groups do, and the fact that all the risk and all the burden is on themselves. And also no dentist really has the level of business education that they want. So while they don't want an MBA telling them how to practice dentistry, they do love having experts able to advise them on tax, on investment structure, on finance, and take care of some of the HR issues and things that have just become part of the hat of the practice owner, right? So most independent practice owners, if they could, they would be dentists if they had the same upside and focus on patient care if they had the same upside and the same control that they do today. So that was the learning from independent dentistry. So we repeated that same exercise and we talked about groups and what do you like about groups? And what they told us about groups is in general, we appreciate their buying power, we appreciate their systems and processes, we appreciate their business expertise, And all of those things are really good, and we see those as net benefits. But what don't we like, and it's almost the inverse of what you like about independent dentistry, we don't want somebody telling us what to do, how long our appointments are, how fast the handpiece needs to spin from the time the patient walks in the door. That was the number one thing. We don't want somebody defining our culture. We like to do certain things in the community, and we want to be able to do it that way. It was really a lot about control and values and alignment. And I don't want to be an employee. I kind of like being an owner.
Right.
So the real insight, and I would say the special sauce of Imagen, and there's lots of things that are different about us, but the special sauce is Imagen was designed to give the upside of both independent dentistry and a group. So at Imagen, doctors have complete clinical autonomy, as defined by, they call all the shots, they define the treatment plan. They can use any material they want. They buy off of our very special deals with our suppliers, but they can buy anything they want from those suppliers. Great suppliers like Patterson and Dentsply Sorona and ADEC have given terrific pricing to Imagen Partners, so they benefit from all of that. But they don't have somebody telling them how to do dentistry. Rather, they have operations coaches that give them analytics and insight into where they can grow. And they maintain ownership not only in their practice, but they have shares in the collective. And those shares in the collective offer meaningful opportunity for wealth creation. When we model it out, most of our partners have a $2 to $5 million larger opportunity with Imagen over 10 years than they would as an independent dentist. So the combination of economic upside, having a business partner to help you with the business issues, but not tell you how to do dentistry, and the philosophy to keep the patient in everything that we do and deliver great patient care, because our core philosophy is you do right by patients, the profits follow. It's not the other way around. That's what attracts people to Imagen. And so, if people want to learn more about that, there's more information either on our website at imagendentalpartners.com, or that information can be garnered by coming to one of our information sessions. So get in contact with us to learn more, but we think we're truly different in that regards, and we truly do offer the best of both the value proposition of independent dentistry and of group dentistry.
That's cool. Yeah. And obviously that sounds like that's some lessons that you learned that has translated throughout your whole career. So what was after that for you? Did you go into Imagen, or was there something in between?
Oh, no. So that was, we're still back in 2001. And
Oh,
so
wow.
we had that successful project, and we had started to show the impact it would have in CEREC sales. And so once CEREC sales started to catch on, the management team was impressed at Sorona, and they offered me the opportunity to come and to be president of Sorona in the U.S. And
Nice.
I took that job in October of 2001, and so worked with Sorona until 2015.
Wow. Okay. So you were there a long time. What was that like, working at Sorona and being president there?
All right. So, I mean, it was great. It was truly an entrepreneurial company. You can be an entrepreneur outside a company, but at Sorona, because when we started it was so small, I got to be very entrepreneurial inside a company, had a terrific team, terrific products, terrific culture, and they were, as long as our U.S. team delivered results, they were very open-minded to kind of alternative strategies, and especially the concept that I went to next after learning the power of peer-to-peer, which was the power of community. And so at Sorona, we really worked hard to build a community around the passion of CEREC owners, and started events like that started out as CEREC celebrations, and today are called DS World. But that really started with CEREC 20 back in 1995. And so we built a very powerful community around the 20,000 CEREC owners while I was with Sorona, and that was a translatable concept, which really is the foundation of Imagen.
How much did Sorona grow from the time that you were there?
So when I believe Sorona did in the U.S. about $30 million, maybe a little less, maybe $27 million in the year before I came as president. When we merged with Dentsply, my U.S. business was over $500 million. And then after that merger, I ran a $1.6 million U.S. business for Dentsply Sorona. But I was part of, on the Sorona side, I was one of the lead people involved in helping to put together the merger of Sorona and Dental.
Man, that's cool. Yeah, I can't even imagine the type of life experiences that supplies, let alone confidence building and everything that comes with it.
Yeah, no, it was great. I mean, I was 32 when I became president of Sorona, and it was just a terrific opportunity for, then a fairly young guy, and I learned a ton. I mean, we could do 3 podcasts and all the lessons from that.
What was if you just had to try and take away one thing, what do you think was the biggest thing you learned?
Well, I mean, it really was. There were a couple of really key insights, but the most transferable concepts were, the power of, for me, that we still use today, were the power of peer-to-peer, the power of community, and ultimately the power of using enabling technologies to really deliver outsized business results. And those 3 themes were incorporated at the very foundation of Imagen.
Mm. Okay. And so you were there till 2015, you said. What did you do after that? 2015?
In 2015, we merged together with Dentsply, and that's when I became the regional commercial officer for North America. Basically, the head of sales, marketing, service, and support for North America for Dentsply Sorona. And I did that.
And you were there
until 2017.
Okay. And then, what happened until you decided to start Imagen?
So I left Dentsply Sorona ultimately because the company post-merger wasn't as entrepreneurial as I am, to be perfectly frank. And so we had become quite large. I was running a $1.6 billion business. And culturally, I wasn't as strong a fit with the company anymore, just because I've always been hard charging and entrepreneurial, and I would say a bit unconventional. And the Dentsply culture was very much more methodical, process driven, right? We deliver consistent results over time, but it was the opposite of unconventional. It was very conventional, right? It was traditional, what you would think of as a large disciplined business would be. That just wasn't my personality. And so while I had success at Dentsply Sorona as well, I felt like I'd be better suited to pursuing more entrepreneurial interests. And so I started a couple of companies in 2018 when I left. One is Charlotte Management Advisors, and one is Magic Money. And Charlotte Management Advisors was really a consultancy that mostly did strategic support services back to Dentsply Sorona, and I continued to deliver on strategic projects for Dentsply Sorona. But that was, a very, very small business.
So you're still running that? You still help with that?
Yeah, I still help with that. I scaled that down some, but I still help with that. And then Magic Money, I was a co-founder of Magic Money, and Magic Money creates RFID devices that are used as digital wallets at special events. And so we do kind of access control and digital transactions at large special events around the country.
Oh, that's cool. And so are you still running that one as well?
No, I am chairman of the board of directors of that one, but I'm not.
Okay. Okay, cool. And so you did that for a couple of years, and then how did the idea of Imagen get sprung up?
Well, I had always had myself an idea for creating a group that really attracted doctors that were in the community that we built around technology at Dentsply Sorona. And in talking to a number of those doctors, they just didn't feel that any of the existing DSOs or DPOs really fit their, they weren't a great cultural fit, they weren't, and they didn't think that it was a good business fit for them. And so I had this idea around building a community around harnessing the power of technology. And then I met up with an old friend of my co-founder and the CEO of Imagen, Rezwan Manji. And he was, at the time, just contemplating leaving as president of Spear Education. And when Rez left Spear, and we compared notes, he had very similar ideas about using the power of education and analytics to really drive faster growth in practices in a growth environment. And so we kind of married those ideas, his ideas about analytics and education with my ideas around the power of technology, to form this idea around, well, what if we could create that group that really leveraged those principles and created and attracted that type of doctor, and that was the nucleus of Imagen.
Hmm. Yeah, that's cool. So you met with him. You guys talked about your thesis, your idea, and then how hard was it to go from the idea to the execution of acquiring the first practice?
So we met in December of 2019. We gave ourselves 90 days to validate the idea, and 4 days later, we kind of committed to starting the company because it just seemed so overwhelming, the need. Um, and so the way that we actually started it is we had an envisioning session where we invited a number of technology doctors and other key influencers into a session in Scottsdale to really validate our hypotheses and learn from them on what it would really take. And that happened in January of 2020. From that point until we became a company, it was either late March or early April when we actually finalized all the paperwork to become Imagen Dental Partners. But the visioning session really helped us to flesh out and validate our hypotheses and the concept, and gave us the foundation to which to build from.
Okay. And so March 2020, you got all your paperwork filed to officially start this DPO. And then what was the next steps? Like, were you guys bootstrapping, self-funding the acquisitions? Did you have good relationships with doctors? Was there a lot of interest from their end?
Yeah, so we had incredible relationships with who we thought were just the right doctors to join our group. And several of them were at the envisioning session as we invited people that we thought might be our partners to that. And so a number of docs at the end of the envisioning session, which is very similar to when we did kind of the other focus groups, because the envisioning session was just a big focus group, expressed interest. If you build this, I want to be part of it. And so our first 3 partnerships were with folks that were at that initial envisioning session, but it took us until April to become a company, and until September to close those transactions. But you asked a couple of other questions. We had both been successful in our previous careers, and so the original funding for Imagen came from the Manji family and from my family to found Imagen, but we were able to secure a line of credit to use the power of bank debt to amplify our equity. And then we have a unique model where our partners get equity as part of their consideration. And so that very specific financial model makes it possible for us to fund transactions without the need for outside financial, other than
Nice.
our bank partners. So all the equity holders are either the founders, management, or dentists, the majority being our dental partners. And the debt is all done through traditional commercial bank.
Did you have existing relationships with these banks from your line of work beforehand?
Reswan did. So, we talked to a number of banks, and honestly, even though now every bank will tell you how brilliant our model is, in the beginning when you try and do something different, people are loath to try something new sometimes.
Yeah.
And so we really did have to find a bank that we had a relationship with, and Reswan had a great relationship with UMB Bank, and they became our financial partner.
Okay, cool. And how much equity do you prefer the doctors to retain?
So every doctor in Imagen retains 40% of their practice. So Imagen owns 60% of the practice. And
Okay.
in consideration, when they're paid for their practice, we pay that consideration 50% in equity and 50% in cash. And so every doctor has not only shares in Imagen, but also shares in their own practice. And so the shares in Imagen are really what's special to them, because as Imagen as a company grows, they not only benefit from the growth of their practice as practice owners, but they benefit meaningfully from the growth of Imagen as equity holders in the collective.
And so, yeah, it sounds like a good model. You are targeting specifically dentists and clinics that have a focus on high technology?
Yeah, so we require that either our partners have CEREC and Cone Beam, or that we acquire it for them in the transaction. And the reason for that is if you know the right ways to leverage those technologies, you can deliver a lot more value and a lot more great patient care. And so our doctors use that technology to do clear aligners, to place implants, to do better endo, to be able to provide sleep dentistry. And it's really that enabling technology that allows general practitioners to do some of those procedures that otherwise might have been referred out to specialists.
So I was having this conversation the other day with a buddy, and it's like in order to get started with business, you have to overestimate the upside and underestimate the downside, and you got to view everything through these rose-colored glasses. Because if you really knew how hard it would be, probably you would never get started, or a lot less people would get started. So, what do you think has been like the most unexpected challenge or the hardest part so far for you guys at Imagen?
There were a couple of unexpected challenges. So we were fortunate to have, between us over 35 years of dental industry expertise, and Rezwan was literally born into dentistry as a member of the Manji family. So we had a lot of expertise, and so we knew some pitfalls, but you always hit some impediments that you don't expect. And for us, there were a couple, like and it relates back to what you do, Austin. The pace of transactions, we had done a number of acquisitions before, but especially in 2021, the pace of transactions was slowed by two things, and this happened to everybody. One was PPP loans that needed to be, you had to apply for forgiveness before you could pledge those assets or transfer those assets. And the other is something that happens all the time, is that most dentists don't know that if they own real estate, their real estate is actually secured also by all the assets of their practice. A lot of people use SBA loans to finance their real estate purchases, and the SBA generally requires that they have a lien on just about everything. And so when we partner with a practice, we need to unwind those practice assets from the real estate loan. And that is a lengthier process than we had imagined it would be, and we've had to work hard to really streamline that.
So a lot of these doctors, they use SBA loans to buy their real estate because they can legally do that because they occupy more than 50 or 51% or whatever it is. But now that's tied up under the LLC of the operating business, and so you have to separate those transactions. You have to separate those two entities into two separate LLCs or whatever. And so what does that process look like? Are you then, because do you acquire the real estate, or does the doctor retain the real estate at that stage?
Right now at Imagen, the doctor maintains the real estate, and they become our landlord, the practice's landlord. And so with an SBA loan, what a lot of people don't realize is the assets that the doctor pledges to get that SBA loan include the assets of the practice. And so while we don't have to form a separate entity usually, because usually the doctor has two LLCs, it's really the asset encumbrance or the fact that they're pledged that needs to be unwound. And a lot of times the SBA, unless the note is small, the bank who holds the SBA loan isn't going to release those assets. And so the doctor generally has to refinance that real estate to separate their practice from the real estate.
Okay. And then how often are they looking to sell the real estate, to you guys, or just so that they're kind of taking all their chips off the table at the same time?
It's probably more often in a group that is literally buying 100% of the practice and the doctor's looking to get out. So most groups, and this is a big difference between Imagen and most groups, we look for doctors that are going to practice for at least 5 and preferably 10 or more years as part of the Imagen structure. And so I would say that a lot of our doctors really like having that diversification of being the landlord and owning the real estate. We have had several that have asked us about when they have to refi the real estate, if we'd like to purchase it. Today we don't do that. That is probably an opportunity that we will pursue in the future. But what I would say is we'll always make it optional on partnerships for the doctor to continue to hold the real estate as long as that real estate serves the need of the practice.
Yeah, no, and it makes sense. I mean, we have this conversation a lot when it comes to the real estate side of things, and it's like, well, if you're getting, it's just a spreadsheet math, right? Like if you're getting a good return on the money that you reinvest in the business, 30, 40, 50, 60%, whatever it is, and real estate typically returns 10%, 15% over time, and you can juice those a little bit more. With different strategies and financial engineering, of course, but, you got to go where it makes the most sense, where you're going to get the highest returns. And if real estate's not your expertise, a lot of times it could hindrance you from making investments in growing the practices and the business side of things that are going to give you a better ROI.
Yeah, and that's where teams like yours come in because for some doctors it makes sense to have real estate as a portion of their portfolio, and if that makes sense for our partner and it makes sense for us, we'll enter into a longer term lease agreement for that. But for a number of doctors, it may make sense to now put their capital use in a more efficient manner, and so that is something that we'll be exploring in the next year or two for a couple of reasons. One is to give that option to our doctors who do want to kind of rediversify, rebalance their portfolio away from real estate. And then importantly, as we start to build Denovos, it is quite likely that we will have a strategy around real estate with those de novo practices.
And what's your strategy for Denovos? How are you guys going to tackle that?
So we've been, to be totally candid, we've been focused on entering new partners and integrating them and building the foundation to support the hundreds of practices we expect to partner with and acquire. And so we had thought that we would start Denovos in 2022, but it really looks like Denovos is a 2023 strategy for us. But we have a vision to really create optimized dental facilities that can serve patient needs in the most efficient manner. And a lot of times that design might be slightly different than what a dentist had built for themselves because the vision was slightly different. And so we're looking at Denovos as a way to both enter new markets and to build really optimized facilities.
All right. So are you going to be like, there's some hub and spoke models that have been going on. There's a lot of times people will acquire a couple practices and then relocate them into one bigger practice. And then it's kind of like a mix between a de novo and a relocation. Are you guys looking at strategies like that too?
We are, and what I would say is we're still developing our de novo strategy. We'll almost certainly do what we call tuck under acquisitions, where we roll practices in, because doing a total greenfield de novo, starting from scratch and building it up from no patient base, can have a longer return on capital than having a seed practice to serve as the patient base. And in fact, there are many strategies where you might be able to roll 2 or 3 practices into a single, more efficient facility. And so we're exploring all of those as strategic options for Imagen.
Okay. I know you guys are primarily, would you consider it specialty, the ones that you are acquiring, or are they still general practice?
So we are today exclusively general practices that offer a certain array of specialty services. And we believe that general practitioners can deliver with technology certain traditional specialty services. Certainly clear aligners, basic endo, implants, single units can all be placed by general practitioners using the right technology, and so we incorporate that into our current practices. The other thing that we're exploring as a strategic opportunity is how to incorporate a more traditional specialty model into Imagen. But today we're all GP. I would call it expanded services GP practices.
So like what kind of square footprint do you guys take up?
Our normal practice when we're partnering is anywhere between 1,800 square feet in an urban area to 3, maybe even 4,000 square feet in a more rural area. The square footage is a little bit location dependent, right? Where land and building is cheap, doctors like, larger, maybe 12 by 12 operatories and more space for their patients. But in markets where the underlying real estate is expensive, you need to be more efficient. We actually have seen that, the environment that you can create in a little less costly area can be at least more attractive to doctors and staff and patients.
Okay. Yeah, and I think that makes perfect sense. So, like, when it comes to more urban areas or less rural or whatever, more competitive, I mean, are you guys evaluating the sites that they currently have? Like, do you look for things like good visibility, high retail destination, like drive to, not drive through, grocery store, anchor tenants? Like, what are some of your criteria?
So we're partnering with the practices as they are, but certainly we do an opportunity scan on the attractiveness of the underlying real estate. So first of all, what the practice is doing today, what their new patient flow is. And so when you're operating a going concern, some things aren't guesses and we're not moving them. But what we do is we work with a company that does a demographic analysis around our sites and tells
us
within 35, 10 miles. What's that?
You guys work with Buxton?
We do not. There might be a good lead for us to talk to. But We actually get that research through Gannett, who's the parent of USA Today. They do
Okay.
demographic analysis for us.
Okay, cool. And the is it like a national study, or are you guys focused regionally right now?
So we are focused in the areas where we're in, and so we currently have practices operating in 8 states. We've announced the 6 states that we're going into, but one of the things that we'll develop, and potentially utilize some of your skill set for is to sharpen our pencil as we evaluate, greenfield spaces for new practice builds.
Yeah, yeah, absolutely. No, that's super cool. So, where do you see, like, what do you see the growth trajectory for Imagine, and where do you see like the dental industry as a whole growing from here?
So dentistry as a whole, I mean, dentistry is a great business. There's only been two recession years, and since World War II, and that was 2008 and 2020, both for pretty obvious reasons, right? So dentistry's underlying growth is strong, and while it's decelerated just slightly from the lofty rates of the kind of 2000s, the macro environment for dentistry is good, but the disproportionate share of growth in the market today is with groups. And so the fastest growing segment of dentistry is kind of your mid-sized DSOs. Large DSOs are the second fastest. And independent dentistry is either flat or slightly declining. And so it depends where you are, what the growth outlook looks like in dentistry. But macro, we expect kind of 3 to 4% continuous growth of dentistry. All of our theses are based on dentistry continuing to grow at a slightly above inflation rate.
Speaking of inflation, I was going to ask you about that next. It's a really interesting time. I don't, and I could be wrong, but to my memory, we've never had a point in time where the interest rates on debt and loans is 3%, 3.5%, and the inflation rate is 6.5%. I mean, the inflation rate is literally double the interest rates that you can get. So it's a perfect storm for real estate because you're taking on debt that literally costs you less than the rate of inflation. You're amortizing it over 30 years, and you're buying assets that historically have always appreciated. So what's your take on that?
It's unsustainable. It is a crazy macroeconomic environment, right? And so I think people should expect that interest rates will have to increase, and hopefully inflation will decrease, right? 6% inflation, especially for practices that have fixed reimbursement because of their insurance component, is not necessarily a good thing. And
No.
there's, I would say, labor inflation in dentistry is as fast or faster than the national inflation rate. So something has to give, right? So people either need to be able to pass along those higher costs, which means insurers will have to reevaluate their rates and their reimbursement structures, or inflation has to occur. But from a macro level, I think that you'll see a change in the stance of the Fed, even though Jerome just got reappointed. I think he's going to have to become a little bit more hawkish and raise rates. And I think and we anticipate that happening. Long term, inflation is inversely correlated with interest rates because people who loan money don't like having negative real returns.
Right.
And this is the first time that I can remember. There have been times historically, if you're a financial historian, where inflation has dramatically outpaced interest rates. I mean, think of like World War II Germany and countries in like Brazil. But that's bad for the economy, right?
Yeah.
Because now where do you put your money where you can get a safe return and it actually is delivering a real return? So can't continue.
Well, here's the thing, though, and I agree with you. I've been thinking that for the past year and a half. I've been wondering why haven't they raised it, and then I realized, well, we have a national debt that's higher than our GDP, and so right now the debt payments from the U.S. are only sustainable with historically low interest rates. If they were to raise those interest rates, even by a percentage, I mean that's going to dramatically. You're talking double now the cost, right? If it goes from 1% to 2%, you're talking double the cost of paying back those debts. And so when I think through it, it's like I don't see how the Fed can raise interest rates without bankrupting the economy or causing some massive catastrophic cascading effect, like not being able to pay Social Security. So how do you evaluate that?
Yeah, no, I mean, it's a very interesting thesis. A lot of people think through that. And obviously, our ability to sustain debt levels above GDP, which aren't good for the country on a macro environment
And they want to do
are
more.
related to the ability to borrow money. But investors need real return, right? And so what has historically pushed up uh, uh, eh, um, interest rates is inflation, right? So the Fed's got a target rate of inflation of 3%. And the Fed, I think, is misguided, but those guys are smarter than me in thinking that inflation is transitory. So they've used the thesis that inflation is transitory to justify keeping interest rates low.
And I
I
can see
don't think
the argument.
most macroeconomists think that's sustainable.
Well, I see the argument that it is transitory for like some goods, but I mean not labor, right? Like when labor goes up, it never comes back down. Like there are not going to be people who will willingly take a pay cut moving forward. If they do, you have to have some very, very, very bad things happen, outside of those situations. And so that part of the equation is never going to be transitory.
Yeah, and people have had real wage decreases. They're usually associated with recessions where you can't find
Yeah.
work, and so hopefully that is not the ending. But I think that the Fed's trying to navigate a tricky situation, right? You've got growing inflation, you've got labor inflation that's the highest it's been in years, and that's because not everybody's come back into the workforce. I don't know that people can sustainably sit out of the workforce. Typically, in a growing economy like the U.S. with a growing population, you've seen actually a growing labor force. What you see is when the labor force declines is that you get into stagnation of the economy. That's what's happening in Japan. That's what's happening in parts of Europe. We're fortunate from a macro perspective in the U.S. To have a hypothetical workforce that's growing, meaning there's enough young people in our country to actually do the work. But I think your basic thesis of people are going to be resistant to pay cuts is right. But I mean that there's a forcing mechanism there as well, right? Is that if people can't afford the increasingly expensive goods and services they need to work, right? And if more people come back to work, then the problem a little bit fixes itself because there's a supply. So the reason for labor inflation in dentistry and everywhere else is there's a supply imbalance, right? More demand than there is supply. There's jobs available, and people have to work in a competitive labor market, have to compete in a competitive labor market, and to do so, you need to hire people, pay more money, right? It's kind of that simple an equation. When more people come back to work, that will ease wage inflation pressures because more and more people will be likely to work for whatever the prevailing wage is. And I think that the labor pressure is transitory, and that's where maybe the Fed's thinking is. I think that the part that is likely not as transitory is I think that there's a number of businesses, you can't see it yet, but haven't been able to push price as fast as their underlying supply costs have increased. And so I think that you're going to see businesses, including in dental and including in other markets, continue to increase. Like when you look at real estate, so real estate has experienced the largest spike in values in many areas, as it has as long as I look back. And I'm not kind of a business guy and look at the economy probably more than most, right? And if you look in markets where, particularly residential, but also commercial with the right cost base, in some cases, the prices have gone up by 50, 100%, right? That's totally driven by cheap money, right? And so when interest rates go up, which I believe they will, that will put a cap on rising real estate values, which is good because it's unsustainable. Actually, I think that as an investor, obviously, if you're holding a lot of real estate, you love the fact that prices have gone up, by as much as they have. But if you're trying to run a continuing business, the best environment is low interest rates, but relatively stable appreciation at a level that is a constant gap. Like if real estate was appreciating 4% and you could borrow money at 3 or 4% and then leverage your equity and then get value out of income producing real estate, that model is sustainable and profitable at the normal real estate returns, which, as you said, most people invest in real estate thinking I'm going to make 10 to 15, maybe 20% if I have a highly leveraged model. But they're not, nobody models in kind of double digit appreciation in the underlying value of the asset.
Yeah, it's been frustrating, I think, for sure, for us trying to find and buy assets. Even though we own assets and we benefit from the upside, It's so frustrating because it's so expensive. It's priced in so high, and then what it translates to is higher rents, and of course nobody wants to pay higher rents, obviously, right? And so it's uphill battle
Well,
right now.
and rents rarely can rise as fast as underlying real estate value can, and so, it's a renter's. It is potentially a renter's market right now if this kind of rapid appreciation retreats some. But what I can tell you is definitively is that underlying real estate values have increased faster than rents have been able to,
Yeah,
because business can't afford the rents, and everything ultimately has to go back to some type of balance. I think there was a reset in real estate values, and real estate has been historically inflation resistant, meaning that real estate long term rises at the rate of inflation. It kind of has to,
yeah.
right? But right now it's outpacing inflation in many areas, and that's not a sustainable situation.
Yeah, yeah, I agree. I think it's got to slow down at some point. I think it's got to stop at some point. But I don't see it going down. I don't see the real estate going down in value because everybody has so much equity in these deals. They're not going to let them go unless there's just some giant black swan event. An example would be COVID, but even that didn't take it out, right? So you literally need another COVID type situation where that's something that's coming completely out of left field that nobody's predicting, that nobody's thinking about, that takes us out. And it's like you can't live your life based on waiting on the sidelines, based on black swans. You got to keep moving forward.
Yeah, I mean, black swan events happen more often than people think, but generally speaking, they're generational, meaning
Yeah.
that most generations don't experience more than a couple of black swan events. Otherwise, there wouldn't be black swans, right?
Yeah.
But I mean, you have to go back to 1920 to get the last kind of global pandemic, and people thought about things differently back then. So
Yeah.
it wasn't in anybody who's really living, right? Mindset of what the implications were, and those are the kind of things that surprise people.
Yeah. Well, this has been great. We got sidetracked, and I love it because I love talking about this types of things. But I really appreciate your perspective and your opinion on what you guys are doing. So, what's a good way for people to get in touch? I mean, should they go to the website, your LinkedIn? How do you like to direct people or get in touch with people?
Absolutely. If you'll indulge me, right, I'm going to make a 30-second pitch. Right, we are looking for great technology practices that want to join America's fastest community of great technology doctors. If you are in one of our states, which are all listed on our website at imagendentalpartners.com, and you think that our model might be interesting to you and you want to learn more, please fill out a form on that web page. We didn't get totally in depth into all the things that differentiate Imagen, but I would say there's quite a bit that differentiates us from the traditional group, and for the right dentist, we make a very attractive opportunity.
And you said that's imagendentalpartners.com?
Yes.
Okay, cool. Yeah, I'll leave that in the show notes so that people can check that out and take a look. And so, yeah, thanks very much. This has been great.
Absolutely. Really appreciate it, Austin. Great conversation, and always a pleasure to speak with you.
Yeah.